August 22nd, 2024. Let's kickstart our mid-monthly chartathon. Tonight's focus is going to be laying the groundwork for the next 2 to 8 weeks. Obviously, we will update this twice per month, but I think now is the time to attack some of the end of summer volatility that we're likely to see, which potentially could have started today. Some seasonality comes into play, where we typically have a choppy September and into October, even during the fourth year of an election cycle. But as always, we're going to take it each day, use seasonality as a framework, and judge everything through the scope of price and price alone. So we're going to go ahead and get started here. It's currently August 22nd, 2024. Let's navigate some summer volatility. So let's go ahead and start off with the disclaimer. Please don't be stupid. Don't risk more than you can lose, and don't misconstrue anything we say today as buy or sell recommendations. We're just looking at charts. The 3 tenets of TTI, if you're new to the group, we focus on price. News is noise and everyone else lies. That's the only thing we care about. Price, price, price. Secondly is absolute and relative strength. We want to own the strongest stocks. And contrary to popular belief, we want to short the weakest stocks. Yes, that is the winning combination. Lastly, momentum. We want to be buying stocks moving rapidly to price targets. Opportunity cost can rob us of a lot of potential profit. We don't want to be locked up in slow-moving trades. So let's start off with the elephant in the room. September is typically a choppy month into October. It happens nearly every year. But when we average out just specifically the election years, there is less of a drawdown and more so a sideways, rangy, volatile, choppy mess. This is, of course, on average, and everything can change. But having said that, having the expectation going into September that maybe we won't be taking as many trades as we were taking 4 months ago, or even over the last 2 weeks, is a good expectation to have. Preserving mental capital and your account capital for the pop post-election, seasonally speaking, is what we're going to want to try to accomplish. Last year, if you think about it, the market drew down from July through the end of October, but it wasn't necessarily a capitulation. We did not have these huge dramatic moves to the downside. There was not a lot of opportunity to short. Bears were not making money. As a matter of fact, the only people that were making money were people that were parking cash in high yield savings accounts for the summer, or they were playing some sort of theta style options plays, right? Market was not bouncing enough to give swing traders an opportunity for new trades, and it was not capitulating enough to give short sellers a big enough move to really make it worth their risk. It was chopping everybody up. This year is slightly different. We should not see a dramatic of a fall off, right? Last year was about 10%, but we should see, or at least on average, we do see range-bound messy chop. So coming into September with that mentality will allow you to hold on to some of those great trades a little bit longer, particularly those of us that were able to establish some free trades over the last 2 weeks. Talking to the guys inside of the Discord all the time, if you have free trades going into Q3 and Q4 of 2024, it's essentially lotto tickets, right? Post-election lotto tickets, and those are fantastic to have. So let's go ahead and start by looking at U.S. sector performance year to date. We can see that middle of July, end of July, runoff all the way to that August 5th low. The higher beta areas of the market got hit the hardest. Surprise, volatility works in both ways. The defensive areas of the market were propped up, and therefore, due to the fact that the defensive areas such as utilities and to a certain extent financials and staples did not draw down as much, meaning they didn't have as much to bounce. They held on a majority of their yearly performance. Meanwhile, the higher beta areas like tech, consumer discretionary, etc., had to have bounced, and they are starting to bounce, which we'll see in a second. Year to date, though, up the most utilities, which is not common in a bull market. Have to say that again. Utilities leading is not common in a bull market. We still have another 5 months to go. We'll see if utilities continues to remain at the top. I have my serious doubts, but anything can happen. As of right now, Utes are leading. It's been a challenging year if you've been outside of the market leaders. Off of that August 5th low, right? So normally we try to peg whatever recent performance towards some sort of extreme, either a top or a bottom. And right now we are kind of anchoring that August 5th low, right? That's the Monday drawdown with the Japanese yen carry trade blow up fiasco. And what we're looking for here is what bounced the most, what has reclaimed their highs the quickest, what has shown the greatest relative and absolute strength. And what we wanted to see off of a bottom was the higher beta areas do so. And at least in the short term, over the last 2.5 weeks, we've seen tech take the lead. And that's what we want to see in a bull market, right? We want to see the higher growth or higher beta areas of the market reclaim those highs the quickest. Tech sold off the most. It also bounced the hardest. We'll see if that's sustainable or not in the coming days. But this is what we would want to see in a constructive bottoming out process off that August 5th low. Financials, which probably weren't on very many people's radar before August 5th, have also bounced and claiming all-time highs, which we'll see in a second. So financials are high up there. Consumer discretionary is an area of the market that maybe not a lot of people were super focused on either because it had been lagging for a majority of the year. But we have started taking positions in tech, consumer discretionary, communications, industrials, all the things that are up the most off of that August 5th low is really what we've been focused on, and that's not on accident, right? We like to follow strength wherever it is. U.S. industry performance, even with the crazy drawdown with semiconductors from nearly a 65% year-to-date performance all the way down to about a 20, we are right back up to 38.63% on the year. A very volatile, high beta area of the market that continues to be volatile and high beta. I mean, it's just that simple. When the market pulls back, semis tend to pull back harder than the rest. When the market bounces and rallies, semis tend to outperform in that aspect as well. So if you are leaning bullish, it would naturally make sense to have more semiconductor exposure than not. One area of the market that we haven't really bought yet off that August 5th low was semiconductors, at least as a group. A couple of us have some positions in NVIDIA, which we were able to flip for free earlier today prior to the pullback. Got a little lucky there. So we have some free NVIDIA plays, but for the most part, we've stayed out of the semiconductor bounce off the August 5th low, and for a good reason. While they did have a big bounce, they were not clearing overhead resistance, and so they are still stuck underneath a bunch of overhead supply, whereas other areas of the market have really started to bounce. So year to date, semis still leading. Gold miners, we have a position in gold and gold miners. Really, there's only 3 industry groups that are outperforming the S&P 500, particularly after the pullback. Looking at the August 5th drawdown, though, you can see semis up, software up, gold miners up, internet up. That's all 3 of those, semis, software, and internet, are industry groups within the technology sector. There's a reason why we started getting long 2 weeks ago in the tech sector. There's a reason. You can see it because these were the areas of the market that were rebounding the hardest. From an industry standpoint, we have positions in all 3 industry groups right now. The sooner we can turn those free, the better. Things that we don't want to particularly be opening right now, even though there's a lot of attention on them. Energy just doesn't make sense. Doesn't make sense to be chasing things that are underperforming the benchmark, SPY being 7.5% right now. Why would we want to go and open up an oil services name, OIH, down there at negative 0.56? It just doesn't make sense to open relative weakness in a market that's bouncing right now. We want to be focused on the winners. Oil, gas, and exploration, etc. Just energy sector not performing well right now. We are seeing a little bit of a bounce back from mid caps and small caps over the last 2 days. You're going to see that in a second when we look through some trade setups. There's a decent amount of small and mid cap setups that are available. IWM back up and over its pivot level, which we've been very adamant about waiting for. SPY, Qs, and IWM getting back up and over those key resistance areas. All 3 of them now are in the green light. And with today's drawdown, we did see some of that small and mid cap rotation, which we're going to talk about in a second. The drawdown today looked less like a new topping out process into some lows and more of a continued rotation into some of the more defensive lower beta sectors. We're going to look at that in a second. But from the August 5th low to the August 22nd current date, we can see once again that large cap growth has been the trade. That's why we went out and bought the Meta, right? That's why we went out and we were actively looking at potentially adding an Apple, although we haven't yet. Why we were looking at and why we did add into, or excuse me, not add into, but open an NVIDIA play, right? We're looking at those Mag 7 stocks because that's where a majority of the flow started going up until today. Given today's pullback, though, you're starting to see some of that rounding out process of smalls and mids over the last week and a half. That has caused a bunch of these things to start breaking out into stage 1, into stage 2 uptrends, which we started buying, right? We've been buying these for about 10 days now. We're going to see a bunch more in a second. Let's update levels really quick, or at the very minimum, look at these indexes from a weekly and a monthly standpoint. Everything always feels like the world is going to end. Today's drawdown felt like the world was going to end. It disproportionately hit some of the Mag 7 stocks and some of the semiconductor stocks. If you looked at other areas of the market, they actually held up relatively and absolutely well. Financials, industrials, materials, healthcare, a bunch of these things are at all-time highs or right up against all-time highs. We'll look at that in a second. But if we objectively take a step back and look at the broader picture here, the S&P 500 on the weekly, does this look like an index that is about to break down into new lows? No. During the monthly charting session at the beginning of the month, we were having questions. Listen, if we break down below and start creating new lower lows, meaning if we break down below like the 520 area and start trending under there with an RSI below the 50, we might have to start thinking about, man, that might have actually been a topping out process. It didn't have the characteristics of a distribution phase, but maybe that Japanese yen carry trade was a black swan and could have actually erupted something into a bigger move. But it didn't happen, so we have to put that in the past. It did not continue to play out that way. As a matter of fact, the S&P 500 up until today was less than 1% away from all-time highs. We're seeing it reflected on a weekly and a monthly basis as well. This, to me, and if you're a technical trader across the board, should look like a very constructive uptrend inside of a bull market. We're expecting the S&P 500 to be at all-time highs again relatively soon, and for sure by the end of the year. This is your patented stair-stepper type of uptrend, right? Higher low, higher high, higher low, higher high. We're looking for a move up and over 560 to validate that all-time high. The Qs have more to reclaim, right? The S&P 500 stumbled less than the Qs because the Qs are a higher beta group of stocks, particularly those semiconductor stocks. They pulled back off of that 493 1.618 fib extension that we put at the end of Q4 2023. We expect, along with the broader market, that this is going to also be at all-time highs relatively soon. And for sure, nothing's ever 100%, but we're expecting that if this bull market is intact, these higher highs and higher lows are going to bounce into new all-time highs above $500. Like on the weekly, it still looks like a constructive uptrend, just like the S&P 500. The NASDAQ is still moving up and to the right over time, and that's why we're not super stoked to go and open up a bunch of shorts on pullbacks. It doesn't make sense right now within the confines of the primary trend because the primary trend is up across the board. The S&P 500 and the Qs. Small caps are a lot harder to kind of decipher through. If you've been trading small caps for the last 3 years, it's been a relatively rough go. Matter of fact, only recently has small caps really broken out and made it, any sort of advance whatsoever off of their bear market range. We're looking for the 198.5 pivot. We finally got it. We started to build out this fractal that we took the longs off of. We got long, and then bam, we got hit with the Japanese yen carry trade, and it took IWM all the way back down near the 198.5 level. Now we've reclaimed that 210 area on the weekly. We're still trading above it, so it is back and green lit, but it has not been a particularly easy last few years for small cap traders. And it has caused a lot of confusion and a lot of anger from some old school traders that generally view IWM as a great proxy for risk. And so if you're in a bull market, small caps should be running. I'm not necessarily against that, but what I will say is that the Russell 2000 is not correlated as high to the S&P 500 as something like the Qs. As a matter of fact, it kind of does its own thing. It beats to its own drum. So if you actually throw a correlation coefficient on the Russell 2K, the S&P 500 and the Qs can kind of do whatever they want. The Russell 2K is kind of moving in a different pace. So as of right now, we are looking to continue to get long small caps and mid caps, but you cannot rely on the thesis that it's a bull market that small caps have to run. Typically, you're going to see this particular area of the market run the hardest due to the interest rate conversation right now. And that just comes down to the fact that, 80%, if not higher, of these companies in the Russell 2000 are just dog shit companies that are loaded with debt. And obviously, as interest rates stay high, they're going to have to accrue more debt to stay afloat. They're going to have to service that debt. It's going to be more expensive, et cetera. So any talk of interest rates coming down, I would assume IWM continues to spike up. And we are expecting that as early as September, right? So small caps continue to be greenlit above 210. Mid caps kind of vibing off of the same idea with small caps. We're back up and over that previous cycle high at 535. We're actually pressing up in towards all-time highs with mid caps. There's a bunch of mid caps that are breaking out. Our Big Blue Sky scanner is filled with mid caps. There were 19 setups available yesterday when we ran through the Big Blue Sky setup in the Discord. We obviously did not take all of them, but it goes to show you that up until today's pullback, but even with today's pullback, there was still some strength in mid caps. Mid caps are looking to break out into all-time highs. So not saying it's a particularly easy area of the market to trade. As you can see, since peaking in like February-ish, we've basically gone sideways in mid caps. But that is a constructive fractal that is looking to continue to break out up towards that 600 area pivot. If that's the case, you're going to want some exposure in mid caps. Those things run hot when they run. The Dow Jones Industrial Average. Once again, not saying it's particularly easy, but this is an uptrend. That is a series of higher highs and a series of higher lows. And we're currently knocking on the door of our first price target that we set back Q4 of 2023, that 41,000 area. That's what we've been looking at, and we're about to tap it. Once again, not saying it's easy, but this is not looking like any sort of distribution. This is not looking like any sort of topping pattern. It just looks like a challenging environment to trade. That's why markets don't give everybody $1 billion. That's why most people fail. They just get frustrated and leave. We're not going to do that. We know the confines of what an uptrend looks like, primary trends. We want to trade with them. We just need a little bit more time and the right expectations. The Dow Jones Transportation Average on the weekly as well. This is working on a massive consolidation fractal that should resolve to the upside. When the Dow Jones Transportation, not if, but when the Dow Jones Transportation decides to join the bull market, I would assume that the components within the Dow Jones Industrial Average are also going to rapidly increase as well. Because if you go back 100 plus years, the old Dow theory, when the transportation average and the industrial average are moving in the same direction, either up or down, the market is moving efficiently. And over the last year and a half, 18 months or more of this bull market, we've been able to make the type of progress we've been able to make without the transportation average moving at all. We've done nothing. So assuming this finally does join the bull market, I would assume that more of those components within the industrial average are also going to rally higher into all-time highs. A bunch of them already are. The S&P 500 net highs versus lows, we're still green. That's it on the weekly. You've probably read it on FinTwit or whichever services you're reading outside of ours. How dare you? But the advanced decline line is still showing market breadth is appreciating. It's the things at the top that are really weighing the index down. If you look at the stocks that got hit the hardest today, they're the Mag 7 stocks. They're the large cap growth stocks. If you look at some of the value areas, the small caps, the mid caps, etc., a lot of those overwhelmingly closed green. We're still seeing breadth expansion. Remember, everybody was complaining just a couple of months ago that market breadth was so weak. It was so weak. That's why the market had to roll over, and it never did. Well, now you have the exact opposite. Market breadth has been expanding for weeks. More stocks are participating than ever before. As a matter of fact, I'm going to show you a chart that illustrates that. And yet the indexes are having a harder time moving up. Why is that? It's because the indexes are not equal weighted. They need the largest stocks to be pulling the index up. That's how averages work, right? So when you think about this stuff, the average stock is performing well. Maybe the largest stocks at the top, which tend to be the most overcrowded trades at the top, those are the areas of the market that are chopping around. If you're looking at net highs versus lows, market breadth is still expanding in the S&P, and the Qs a little bit choppier, which I don't need to tell you. You already know that. If you're trading, you know that the Qs, particularly the tech area of the market right now, it's a little bit choppier than some of the other sectors, and we're seeing that reflected in the highs versus lows on the weekly, right? This is not inherently bearish, but it is choppy. This is summer choppy, volatile trading. We are not seeing a big, long bearish range like we saw in 2022, where you have multiple months of new lows. Even last summer, right here, we saw 3-4 months of just straight new lows. We are not seeing that. So for people to sit here and say that the market is about to fall into a new bear market or that was the top, we're just not seeing it reflected in market breadth whatsoever. Volatility is back to the decade average under 20s. Generally speaking, we range around 12s. Trade of the decade for volatility traders if they were able to short the VIX up at 65. But here we are right back in. That was the Japanese yen carry trade. It lasted approximately 1 day. 1 day. It was the largest single move in the VIX And now we're right back down to the average. It's just that fast. That's how crazy the last couple of years of trading have been. For everyone that says this time is different, to be honest with you, we've had a lot of first times over the last 4 years. A lot of things are different, actually. You want to know what's not different? Bull markets and stocks being above the 50 and the 200-day moving average. Right now, stocks above the 50-day moving average are sitting at 74.35%. It's on the weekly. Stocks above the 200-day moving average are sitting at 75.34%. This has drastically improved over the last few weeks. When we had our last monthly charting session, it was the beginning of August, I believe it was. And these readings were abysmal. At least the 50-day high was showing you that short-term weakness was prevailing. Only 46% of the stocks in the S&P 500 were above the 50-day moving average. We now have 74%. And the 200-day moving average, which is generally kind of the gauge of primary trend, that old Paul Tudor Jones quote, nothing good happens below the 200-day moving average, be long above it, and be cash or short below it. We were sitting at 61.43. So even with that massive drawdown, the long-term trends of most stocks were still up. So it's important to understand how that 200-day moving average can anchor expectations moving forward. Okay, right now, market breadth is improving, and a majority of stocks are trading in intermediate and long-term uptrends. The put-to-call ratio is not really showing anything special. We would expect that if we were going to blow off the top here, that puts would just be absolutely outrageous, and to be honest, they're not. This is just, there's not a whole lot to go off of right here, but it does not appear like we're going to have some sort of short squeeze into all-time highs. I think most people are probably sitting on the sidelines, at least people with a bunch of capital right now, sitting on the sidelines, kind of observing what's going on. Maybe they're waiting for Jackson Hole tomorrow, right? Jay Powell to be speaking. We do not see an increase in puts. And as a matter of fact, commercial traders are actually de-risking their shorts, which we're going to see in a second. High beta stocks still holding that pivot high. We're looking for a resolution to the upside, even though we were technically at all-time highs in SPHB at the beginning of July, that July 10th. I know at least inside of our Discord, a lot of people's accounts peaked on that like July 5th through July 13th kind of corridor. High beta stocks peaked at that particular time as well. So it makes sense if you were trading high beta stocks, growth stocks in particular, tech, communications, consumer discretionary, your accounts probably peaked around that time as well. But we're still holding that previous cycle high, that 2022, right when bear market started. Right, we're looking for a resolution to the upside with a price target in between $98 to $100. And if that's the case, all the high beta stocks that we own should do pretty well. We're not there yet, but it is very constructive to see that we're holding the level. If we look at that against low volatility, though, I think this goes to show you more than anything that kind of sector rotation. The indexes are continuing to hit higher highs on a weekly basis. But the higher beta versus lower volatility stocks ratio chart is not. We're back within the range underneath the previous cycle highs. Now, it's not to say it's the end of the world. It just goes to show you that there's different types of stocks that are working right now, pushing the index up and to the right over time. And it's not the higher beta stocks. It's just not right now. So if you're looking at new trading opportunities, don't be afraid to go and own some of the lower volatility stuff. They are outperforming on a relative basis, not necessarily on an absolute, but on a relative basis, they are. So if we're pulling up charts, particularly those of you in TTI on Sundays, and we're looking at like 2 ADR, 2.5 ADR, don't be afraid to go and own some of that. Coca-Cola trade that we put on, right? We put the Coca-Cola trade on. That was a lower ADR trade. Seems to be working pretty good. Don't be afraid to go out and own some time on those trades and let them work. Who knows how long or how far these things can go. 6+ months of expiration on a trade where you necessarily don't have to worry about a 20% gap down overnight. It's a pretty goddamn good deal to me, right? So lower volatility, outperforming, higher beta as of right now, which rolls into the consumer discretionary versus consumer staple kind of ratio chart that we look at. Intermarket analysis is an incredibly powerful tool to get a general idea of market forces, right? We can check anything from risk to sentiment, different assets against each other. It really gives us an understanding of how tolerant people are inside of the market. As of right now, we're seeing a slightly less tolerant approach because generally consumer discretionary is going to be outperforming consumer staples in a risk-on environment, right? Consumer discretionary, basically you can think about it as if you have a bunch of money in your pocket, where are you going to go spend it? Amazon, Tesla, cars in general, discretionary spending. You're going to go out and you're going to buy shit. But what happens if you don't have a lot of money in your pocket, or there's a recession or something like that? Consumer staples names start to outperform, right? You're always going to buy Coke no matter if you're rich or you're poor. You're going to buy McDonald's for the most part if you're rich or you're poor. I don't want any arguments if you don't like McDonald's. I just spent 8 weeks in Europe and every single McDonald's was slammed, okay? I get it. It sucks, but it still gets bought. Those consumer staples names, though, tend to outperform in risk-off environments. They're lower beta. They're more defensive in nature, right? So right now, this isn't the end of the world, but we would expect in a full-on risk environment, consumer discretionary to be outperforming consumer staples. And we're not seeing it over the last 6 months, right? We've been in a relative downtrend, actually. So this is something to consider when you're thinking about should you own a consumer staple stock or a consumer discretionary stock. Right now, staples are outperforming, at least from a sector standpoint. High yield corporate debt versus treasuries. This was the canary in the coal mine a couple of weeks ago. It was starting to break down. This was the one chart this year that actually kind of scared me. So this year I've been full bull basically the entire time. I just went through it earlier today. I went through some of our January and February videos, and we were talking about be long 2024. Forget what everybody's saying about a recession. Forget about this market rolling over. There's this. All of these important points are telling us to continue to stay long. And that was the right call. Up until I saw HYG IEI break back down with the force that it did. And it just so happened that 2 or 3 days after this ratio started to break down, we got the Japanese yen carry blow up. So I didn't time it by any means. Don't get me wrong. But this is a fantastic ratio chart when it comes to gauging risk, right? Generally in a risk-on environment, this ratio is going to be up and to the right. High-yield corporate debt is going to be more attractive than treasuries because obviously it could yield higher potential rewards. In a risk-off environment, you would expect them to roll back over into treasuries. Right now, we're back up and over that previous pivot high that we sat in all last year. We'll see if we can continue to stick higher highs. As of right now, we have yet to reclaim the intra-year highs. SPY versus gold. This is one of the more compelling charts for me because obviously we have exposure in both stocks and gold. This is the classic stocks versus rocks argument. But as we're going to see at the end of the webinar, going back to 2020, it doesn't really matter what you bought. If you bought the S&P 500 or you bought gold, you're basically performing the same, which is really crazy for me, right? That doesn't make a whole lot of sense. Normally, stocks are supposed to outperform, but over the last 4 years, gold has performed very well. So as of right now, we're right back within this range that we've been sitting in since the bear market low. There's really not a lot from an absolute performance in the S&P 500. There's really not a lot of edge there if you're looking at gold versus stocks right now, at least the average, right? Own either of them. Both of them are going to be moving relatively the same. Actually, there it is right there. Look at that. Going back to 2022 lows. The S&P 500 is black and gold is orange. There's really not a huge edge to gold or the S&P 500. They're both performing relatively the same. I'm glad we own gold. That's all I'm going to say. All world country, ACWI, you would expect in a bear market rollover that this particular chart would be breaking down back underneath 107.5, and it hasn't. Not even close, actually. It bounced 2 weeks ago, continues to bounce, potential all-time highs coming up. This is giving us a good look at emerging markets. Chinese stocks, we had actually talked about potentially owning Chinese stocks, BABA, etc., but we threw that out the window the very next day. Guys, listen, Queb, until we're up and over 3250, 33, I unfortunately forgot to delete that circle, so I can't read it. I think it's 3250, but this is just a no-go zone for the most part, right? Everybody wants to own BABA, and it's just a chop zone. Over the last couple of years, it's just been a terrible trading vehicle. If you caught the short at the top of 2021, congrats, you made a bunch of money, but I personally don't know anybody that did. I know people that bought the dip and got absolutely crushed by it, and we had to work with them to get out of it for a minor loss. But over the last 2.5 years, this is a massive horizontal channel. This is a stage 1 accumulation, actually. If we want to get up and out of Chinese, or if we want to get up and out of this stage 1 and into Chinese stocks, we got to get above 32.5. So that's what we're looking for inside of TTI. I'm not saying never own Chinese stocks, but from a trading standpoint, that is 2.5 years of underperformance. We'll own it when it clears overhead supply. Can we all agree on that? Emerging markets, including China, has not reflected well. We're up and over the pivot point at 42. So it does show that emerging markets are trying to make a breakout, but Chinese stocks in particular are holding them back. So why don't we take them out? What does it look like if we take Chinese stocks out? Well, we can't. Hell of a lot better. Chinese stocks, it's not an emerging market problem. It's a Chinese stock problem. For whatever reason, they're not working. So stop. If you're in that mindset of you got to own Chinese every year, around this time, there's going to be headlines. Mark my words. Within the next month and a half, there will be words on FinTwit and the media that the Chinese government is about to fiscally stimulate the economy and blah, 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 and go out and buy this stuff. Every year in Q3, we get the same load of shit, and it never works. Do not feed into it. You're a technical trader. Buy strength. Don't buy headlines. Check out this emerging market chart without China. It looks incredibly different, right? Look at the overperformance without China. If you want to own emerging market names, look outside of China, which we have all year, by the way. They do pretty okay. The S&P 500 and U.S. domestic stocks, I think still have had the better year, but emerging markets obviously offering an opportunity at owning a breakout. Here's that equal-weighted S&P 500. I told you I was going to show it to you. This is all-time highs, guys. The average stock in the S&P 500 is working. Once again, further evidence that whatever we just saw today is not necessarily indicative of a new bear market low, or that was the top, or we're about to break down into anything could happen. It's just very, very uncommon to see the equal weighted S&P 500 at all-time highs prior to the market rolling over. You would generally see this roll over with the market. Market breadth would really start to deteriorate because distribution takes place across all market caps. You generally wouldn't see this. So once again, I'm not going to talk about it anymore outside of maybe some sector stuff, but this is not the most bearish stuff you've ever seen, right? I think we can all agree, still relatively bullish. Actually, I'm very bullish still, but through the end of 2024. Equal weighted QQEW has obviously not performed the same as the S&P 500, further showing this is a sector rotation issue, not a total market issue, right? The average stock in the consumer discretionary space, which a lot of them are in QQEW, has not worked well this year. It just hasn't. Outside of retail, lots of consumer discretionary stocks, like Nike, Starbucks, etc., have not worked well. So it is pulling this down a little bit, but we are holding the previous pivot highs, 2021, 2022 high prior to the bear market decline. That's why we're still willing to go out and buy this stuff. If we were underneath 121 and trending below it, we would be in more of a risk-off mindset, at least inside of these growth names, right? But we're not there. We're consolidating. And as you saw with the MDY chart, as you just saw with the RSP chart, these consolidation fractals up and over pivot highs tend to resolve in the direction of the underlying trend. I don't know when it happens. If you can time a market with any sort of accuracy, you're going to be a billionaire within like a week or two. So congratulations. But for most of us, we don't have that type of knowledge, if you will, or that skill set. And so we're typically just going to say, listen, this will probably resolve to the upside. I don't know exactly when, but we're going to continue to place our bets on strong stocks within this area of the market. And when it does eventually resolve to the upside, we're going to make a bunch of cash on the positions that we own. Feel like that's a more constructive way to approach this instead of trying to time the actual breakout, because it's been a hard year to do that for a lot of things. One thing that it wasn't hard to do was own the TLT trade above 92. And I continue to think this is a bottoming out process in bonds. We have a position in TLT. It was as high as 75% for me just 2 days ago. It's back down to 30% for me right now. It's a volatile trade, but there is a bottoming out process in my view with bonds. First off, we are now currently trading above the 50 RSI. And on the weekly, this is the first time we've trended above the 50 RSI since 2021. So almost 2 years. The first time we are no longer in a bearish momentum regime. Price is hitting higher highs and higher lows. As you can see here, it's very obvious. We got the lower low into a higher low. We got the lower high into a potential higher high. I'm looking to add in above 100. That trade will come on when we clear 100. We do not want to front run this. This looks like an incredibly attractive setup for those of you that have not already grabbed this. We grabbed the January $100 calls. We have some crazy cowboys that grabbed the January 2026 calls. We're going out there on bonds. I'm not going to tell you you're going to make 1,000%. I can't legally tell you that. But I do want to own bonds off of any sort of bottoming out process with time. I think it'll be a staple within a portfolio. I'm happy to own the January 100s right now, looking to add in above the 100 area pivot, which who knows when or if that's going to happen. I thought it could have happened within the last 2 weeks. Unfortunately, we've been trapped underneath. So we'll see if we get that breakout relatively soon in TLT to add more. As usual, CTAs or your professional money managers have been caught offsides. I'm telling you, these guys have had a terrible year. One of the worst years in recent memory. These guys have not been good at timing the market. Once again, going back to August 14th, they are the lowest amount long since January, meaning they missed the entirety of the last week and a half of the run-up. Now, whether or not the market capitulates into some new lows and they look smart, maybe, but probably not. As a matter of fact, they probably have been adding in over the last few sessions because clients are probably screaming at them that markets are near all-time highs. Why are they not exposed? You know how this stuff works. And so they're forced to buy higher, and they just get caught all of the time. Here's my question to you guys. CTAs are professional money managers, and they can talk on Twitter. This is obviously a survey. How many of these guys do you think contribute to the Twitter conversation? And seeing this type of stuff, would you validate or hold weight on for their opinion if you knew that, for example, they were underexposed long, the worst since January of 2024, a week or 2 weeks ago? Just massive, colossal fuck-ups these guys have had all year. If you knew that these guys were on Twitter telling you not to buy stocks, would you listen to them? I don't know. I'm not telling you to do so or not, but they've had a very, very bad year. Commercial traders, based off the CTO report, are still net short, but the hedges are decreasing. So given the fact that the Japanese yen carry trade probably allowed these commercials to offload a portion of their shorts for major profits because they were short and hedging into the beginning of July. We had talked about that during the July monthly charting sessions, both of those. They have reduced their amount of shorts, and they are starting to swing back in towards a neutral position, potentially long, coming into the middle of September. As of right now, this data is about a week old, though, but we are seeing a decrease in amount of shorts that commercials have, which is generally pretty good for the market, right? So I want to bring something up. We've been told all year that the consumer is weak, right? I tweeted about this yesterday. We talked about this a lot in the Discord. Now, I'm not telling you to go out and buy any of these in particular, but I'm trying to kind of show you guys the idiocy of, CTAs and headlines and this crap. You're technical traders. You follow price in this room, in this community. We follow price. We don't care about opinions or bias. So when you read articles like, oh, the consumer is dying, my neighbor lost his job, eggs are expensive, credit card debt's all-time highs, like, listen, maybe all of that's right. But how is that going to make you money when Ferrari is at all-time highs? You going to short Ferrari because it's at all-time highs? Feel free. The consumer sucks and rich people aren't buying these things. Why is the stock up, right? Why is this particular stock up? What about Walmart? If Walmart sales are down and the consumer is not buying as much shit from Walmart, feel free to short it. It's at all-time highs. Feel free. If you shorted it into its earnings report, you just got blown up. Feel free. Short it. How about Dick's Sporting Goods? All-time high. Another name that supposedly should not be at all-time highs. The consumer is dead. Who's going out and buying baseball gloves nowadays? They can barely afford to eat. Apparently somebody is, because the goddamn stock's at all-time highs. What about Ross Stores? And the list goes on. This is after hours, so I guess Ross just reported earnings, and it's gapping up into all-time highs. Abercrombie and Fitch. Right? All of these things, I can name a million of them off the top of my head. I'm not telling you that the consumer is not weak. I'm not here to argue macroeconomics or data or whatever. I have my own opinions, but they don't creep into my trading. My trading is exclusively based around trends and price. If you have a problem with that and you're a technical trader, you're going to have a very hard time consistently making money in this market. You have to be able to detach the headline and what you think is correct from what is actually happening. So there's 4 really good charts, by the way, that told you, yeah, the consumer might suck, but the market doesn't for these stocks, right? Last one, I guess, TJ Maxx, all-time high. By the way, Starbucks, huge rally off of earnings. It looked like a failed news report. That'll go on our Trade Ideas tab when it starts to complete its change of direction setup. It's not there yet, so it's not on Trade Ideas, but look at that stock, right? Consumer discretionary stock that everybody had written off and then rallied double digits. Like, come on. So let's break that consumer is weak thing. Last one I want to point out, just because I saw it on Twitter right before, actually it was this morning. I can't remember the damn guy's name and I forgot to give him credit. Scott something. So I apologize in advance. But he put this together this morning and I just thought it was hilarious. Lowe's cuts full year outlook as it expects weaker home improvement. Americans are doing less do-it-yourself. It's another worrying sign for the economy. Lowe's follows rival Home Depot with dismal profit forecast. And if you look at the actual chart and you're inside of TTI for longer than 3 months, this is a setup above 26150 into all-time highs. We're buying that. I don't give a shit how few people are shopping at lows. I don't care whatsoever. This is a 2+ year base breakout to all-time highs above 26150. We're not there yet. And if we don't ever get there, I won't buy it. But this does not look like a topping pattern. This looks like it will eventually resolve to the upside into all-time highs, like the 10,000 other charts we've bought over the last 18 months. So headlines are telling us, watch out. The chart's telling us there might be an opportunity relatively soon. Choose whichever one you want. Let's talk about those all-time highs. New themes emerging. Today, the market felt like everything was on fire. We were going to die. And yet, 5 or 6 sectors are at all-time highs. Think about that. 5 or 6 major sectors are at all-time highs. Communications traded today, all-time highs. Google, Meta, Netflix, T-Mobile, just 4. ASTS to a lesser extent market cap-wise. 4 large cap stocks that are pressing up near all-time highs, contributing to communications at all-time highs. Consumer staples at all-time highs. This is your Coca-Cola, your Pepsi, your Walmart, your Costco, your Kroger, your McDonald's, all-time highs. You don't have to trade these if you don't want to. As a matter of fact, this is overbought territory. This is the most overbought staples have been since 2018. This is higher than the bull market of 2020 to 2022. This is higher. And by the way, for those of you inside of TTI, we're not afraid to own things that are overbought because we know that overbought conditions can last for an extended period of time. Overbought is good if you're a breakout momentum style trader, which we are. Shows us that bulls are in charge and we want to own it. So staples breaking out all-time highs. That Coke trade we just put on a couple of days ago, right? None of this is on accident. Industrials. We have a slew of trades on right now that are industrial related. And we're going to look at a couple in a couple seconds here. Industrial. Does that look like a topping pattern? Because it's at all-time highs right now. To me, this looks like a continuation fractal with the price target up near 145. Why would you not want to be long this? Do you really expect this to break down into new lows after resolving to the upside? I don't. It could, but I don't expect it. And I'm willing to put my money on the line and say that it's going to continue up instead of down. How about healthcare? We have exposure into healthcare right now. Look at the bullish momentum regime. Going back to the Q4 of 2023, RSI came down, tested the 50, it bounced. This is now very firmly an uptrend controlled by bulls. Momentum confirms it. Price confirms it, right? We're long this particular part of the market because there's strength there. Do you expect this to roll over right now, right after the breakout? Probably not. Probably not. How about financials? All-time highs. JP Morgan, American Express, Goldman Sachs, all of these companies that are breaking out into all-time highs and resuming their uptrends, right? Am I crazy to sit here and think that if there's like 4 or 5 major sectors breaking out to all-time highs, I refuse to go short this market with any sort of size? I refuse to roll over and think that this bull market is over. This is not typical distribution behavior, guys. This is not. This is not how markets top out. You don't see breakouts across multiple sectors at the top of a market. You see that in the middle of an uptrend. What about materials? Right there at near all-time highs. What do you expect to happen after this? This little bull flag on the right-hand side of a consolidation phase. Call it a cup and handle, whatever you need to make yourself feel better. I would assume this rallies and breaks out. Now, it's a lower beta area of the market. So I'm not jumping at the opportunity to own a bunch of materials, but you're going to chalk this up as bearish? This contributes to the S&P 500 in the broader market, right? We just went through 5 or 6 different sectors. Every single sector is above their 200-day moving average for the first time in a long time. Say that again. Every single sector is above their 200-day moving average for the first time in a long time. Now look at the first one. Utilities is up the most, so I'm not going to sit here and scream that this is a full risk-on environment, and if you're not max long, you're dumb. No, I get it. I understand if utilities are leading, it's probably not the healthiest of uptrends right now. You know, we really want to see the higher beta areas outperform and really reclaim that leadership role. But if you're shorting this stuff right now, you are playing against multiple trends, primary, secondary. The odds of you losing on a short here are exponentially higher than losing on a long, at least over our time frame, 45 to 180 days. No idea what it does tomorrow. No idea what it's going to do next week. But over the next few months, everything is pointing to higher highs. Everything. Having said that, entries matter. Let's talk about some trades. So for the obvious trades here, I normally don't append options trades to the monthly charting session because I like to dive into these with you guys. But I had to redo this, about 50% of it after the market closed because we had such a dramatic pullback. I wanted to make sure that all the talking points that I was going through were still valid, and they were. But I updated the chart. So I had some extra time. I went through the options chain and looked at some of the plays that we're probably going to take, or at least that are options of focus, if you will, off the breakouts. So we're going to go through some of them that have options plays. Some of them are just straight shares plays. App11, trade that we've taken off the 45 pivot. This was our first 1,000% winner of the year, I believe, for most people. For most people, this was their first 1,000% winner ever. So congratulations. Here we go again, reloading above 89.50. We want to be long. Intermittent price target $100. Overall price target $115. You have a opportunity to own the October 100s or the January 2025 110s. Don't pay more than $5 for them. There is a select group of traders inside of the Discord that have already longed this stock. This will go out as a trade idea as early as tomorrow. App11, very good large cap tech stock showing leadership capabilities above an upward sloping 200-day moving average, RSI above the 50. Love it. Rocket Lab. This has not yet, do not buy it yet. We've looked at this multiple times. We want to own it above 765. I get the allure of wanting to own an options play on this. Apparently it's a Wall Street Bets special. I didn't know that. So there's a crap ton of volume right now coming in because Wall Street Bets is buying the shit out of this. But the IV is so incredibly high that unless you play some sort of theta style play or you get incredibly lucky on the breakout, you're going to get crushed via IV. So I do think this is a better shares trade. But at 7.61 ADR, are you really going to complain? This thing moves super quick, even for a shares trade. Want to be long above 765, currently trading 709. Price targets at 10 and 14.5. Big opportunity here, Rocket Labs, off of an industrial-related play, right? We were just talking about industrials at all-time highs. This is a mid-cap industrial-related play breaking out of a stage 1 into a stage 2. Powerful setup. Halo, we already own it, but I wanted to show it again. Healthcare, mid-cap. We own this above $59. The pivot, targeting $70 and $77. Look at the bullish momentum regime, upward sloping 200-day moving average, big blue sky territory with a 3.26 ADR. This was a shares trade, but I know a couple cheeky guys inside of the Discord grabbed some options. I just wanted to point it out because we're looking at healthcare-related stuff as well. Granite Construction, GVA. Who wants to own an Irish cement company? I don't know about you guys, but I'm pretty sure like Irish cement companies are all mafia related, right? It's a $3 billion infrastructure company out of Ireland breaking out into potential all-time highs. A lot of volume on those December 80s. Price target here is up near 105 off of a risk on level at 68. So we're a little late on the breakout, but with the price target so far away, it's fine. Stops underneath range high, so somewhere underneath about 66, 65-ish. So we're giving this thing a pretty liberal stop loss of $4 or $5, but the price target's really far out there. So it's a really high risk reward set, about 4 to 1. So 3.31 ADR, upward sloping 200-day moving average within a bullish momentum regime. Once again, the December 20th, 2024 $80 calls, don't pay more than $2 for them. A lot of volume on those. This is a very unique play. We don't have a lot of materials related exposure, so this will give us a potential opportunity to own something with materials breaking out all-time highs. It's also an emerging market name, right? Real estate sector. So listen, real estate sectors reclaimed their 2020 highs. I went through and tried to find a goddamn real estate play on the options chain. I did. It is hard. There's just not a lot of volume or liquidity on the options chain when it comes to real estate names. But we should own this. We really should. I mean, this is a part of the market that's probably going to do very well if interest rates start to get cut. We're already seeing it priced in. Does it make sense to own it above 42? Yeah. Is this thing going to move super quick? No, not at all. So we're going to want 5-6 months, and we're going to choose a relatively tight target at 45. January 17, 2025, 45 calls. Don't pay more than $1.10. Spread's kind of wide right now because market's closed. Make sure you do not pay more than $1.10. Do not get screwed. If the spread's wide, you can get screwed with the ask. Don't do it. Limit order in. If you don't get filled, we'll go to the next one. But if you do, you're grabbing a piece of the total real estate sector into a potential stage 2 breakout. Awesome. Upward sloping 200-day moving average. We have just started a bullish momentum regime, so by no means are we late on this trade. We are gapping up after hours. We'll see where we're at. 1.59 ADR. Once again, don't expect this thing to move 20-25% the next week. It's probably not going to happen, guys. But from a real estate standpoint, this gives us liquidity to get us in. Meta, we've obviously already started to open this, but just in case you didn't, those contracts are around where we opened them. I think they're trading for 1460 right now. We opened them up for 14.5 max. So if we get a drawdown tomorrow morning, there's an opportunity for you to own the BRB pullback. 525, we want to own this for a price target up near $600. The interim price target, and then the ultimate price target up there by January, hopefully $700. We want to own the 650 calls for no more than 14.5. Once again, January 17, 2025. Lots of volume on those plays. The January, the December, and the November, all the 650 calls are getting bought the hell up. We want to own that, right? This is one of the best looking Mag 7 stocks. Even with today's pullback, it only closed down 0.6%. Just a lot of relative strength for whatever reason. Once again, it's not up for us to decide why the market doesn't want to sell Meta, but it is up for us to notice it and then own it. And we are, and we will continue owning it. This was the biggest trade dollar amount wise that we've had from traders inside of the Discord last year, right? Dustin owning a $200,000 win on Meta. This is the exact same setup as last year on Meta. Obviously, just because it happened last time doesn't mean it has to happen this time, but there's a pretty good chance that it's going to rhyme. So I'm going to own this above 525. A pullback tomorrow gives you an opportunity to leg in more. Upward sloping 200-day moving average, 50 RSI, 3.31 ADR, and into an all-time high. Own Meta. It's the best Mag 7 stock in my opinion. Roblox, this is not a trade yet, but this is a massive stage 1. We've been stalking this forever. There's no trade on it yet, just putting it on our radar. Want to own this above 48. This is a widowmaker. How many people do you know that have traded Roblox in the last 2+ years that have lost their money trading it? Probably a lot. Reminds me of Alibaba, right? Huge, steep decline down into a massive stage 1 accumulation. This will be a trade we want to take, just not yet. Look at the right-hand side of the chart. That mountain type of volume on that VRVP indicator gives us the understanding that financial institutions are accumulating Roblox. This is not a distribution cycle whatsoever. This is an accumulation phase, and as it breaks above 48, we're going to want it. It looks like it's going to be a very powerful breakout. We want price up and over an upward sloping 200 moving average when it does, and we'll own it. So watch list Roblox, $28 billion software stock. How about CRH? Another materials related play. The December 20 $100 calls for no more than 220. This was a play that we were originally looking to take at the end of 2023, but we opted out and decided to go for some higher beta stuff instead, which was the right call at the time. But now that materials are breaking out to all-time highs, we're going to want to grab this. Why would we not? This is a nice rounded bottom continuation fractal up and over 88.5. Price target 100. Next price target up 115. December 20, 2024, $100 calls no more than $2.20. Upward sloping 200-day moving average, 50 RSI is above, RSI is above 50, worth a crack. Also at 3% ADR, it's a relatively volatile materials name. So if you're looking to trade shares, opportunity to own that as well. Intuit, not a trade yet, but this is once again a massive base, 2+ year base breakout that we're going to want to own. Look at the right-hand side. Our intern, Randy, that just started this week, we're going to get him loaded onto Circle and contributing trade ideas and reports relatively shortly, just getting caught up to speed. He brought up something great inside of the Discord. He said, look at these bases on top of bases. And he's absolutely right. Randy is right. When you look at this particular setup, this is a massive rounded bottom into a continuation fractal off to the right. We want to own it above 675. It's not there yet, so there's no trade idea appended to it yet. There will be an options trade available, but we want to own it above 675 for a price target of anywhere between $850 and $900. As long as price is trading above an upward sloping 200-day moving average and RSI is above the 50, we want the all-time high breakout. So put this on your watch list along with Roblox. Not ready yet, but could be relatively soon. Added PayPal to this particular webinar because we did grab it. It is working. If PayPal does decide to pull back tomorrow, if the market pulls back, there's an opportunity for a BRB setup, which is why I added it. We grabbed the January $80 calls, at least from a community standpoint. Some of you guys went way shorter than that, which is okay. We talked through this trade extensively on the Sunday night strategy session. So I believe for most of you, you have the gist of it. But if you missed it, we're looking to get long above the 68 pivot. If there's a pullback tomorrow, you can leg into the January 17th $80 calls, no more than $3. We're at the beginnings of a potential stage 2. This is still a tricky trade. This is the third time we've tried PayPal at these levels. The first 2 trades, at least for me, were red. This trade, we'll see if it works out for us. For the first time, we have an upward sloping 200-day moving average with a gap up. So this has changed slightly the dynamic of the trade in favor of bulls. But we have so much overhead supply to work through in PayPal, it's probably not going to be as an aggressive breakout as most people expect. As long as you have that in your mind, it'll be easier to hold through this stuff. But PayPal looking like it wants to finally break out yearly highs. Once again, if it pulls back, gives you an opportunity to own it if you missed it. C Limited, just like Roblox, just like Intuit, a trade that we're going to want to add above $88. This is just a simple stage 1 into a stage 2 breakout. Own it above 88. Trade idea will be out. We're looking at the $100 calls for no more than $4. You want to try to front run it at your own dismay, feel free. We tried. We got popped out. Took it for a loss. But we do want to own this. This is a massive accumulation base. 200-day moving average is now sloped up. Price over it. 50 RSI overbought territory after earnings. 3.84 ADR. This is just a great internet and emerging market name. This is an internet retail name out of Southeast Asia. Own it above 88, price target 120 to start, which is great because if we're looking at those January $100 calls, we can get it for $4, which puts us massively in the money if we hit our price target within the next 6 months. Next emerging market / internet retail name that we actually did start buying yesterday, Coupang. This will go out tomorrow as a trade idea. I believe the contracts are slightly down right now, so you're going to get a better feel than the rest of us inside of the Discord. But we wanted to make sure that this thing was going to hover around $23, and it does look like it is going to. So it did show some relative strength today across the broader market. It's a $41 billion emerging market name. It's the quote-unquote Amazon of Korea. We want to own the February 21st, 2025 $25 calls for no more than $2. This is not necessarily our trade idea. Love the chart. We wanted to get long Coupang. We've actually been long Coupang in the past. 200-day moving average rising up, RSI above the 50, but there's an incredible amount of volume and open interest on those February $25 calls, and so we're just following the whale. Whoever's stamping out that in open interest, we're going to go ahead and own it with them. It makes sense. Also, the February IV, for whatever reason, is way, way, way lower than the January IV. So we're going to take advantage of a lower IV environment in 2 straight calls. We expect this thing to break above $23, and we're going to ride this thing up to 25 and then 35 over the next 6 to 7 months. Viking Therapeutics actually came up as a trade idea a long time ago. One of our market research guys asked us if there was a potential long off the 59. And at the time we had said, listen, maybe not. It looked more like it was going to try to fill the gap. Now, hindsight's 2020. Nobody took that trade, I don't think. But it did look, it did try to fill the gap here. But now it's giving us a bull flag breakout potential here after a massive 5-6 year base. 200-day moving average sloped up, RSI above the 50. If you're into the mid-cap pharma biotech space, healthcare all-time highs, biotech industry group breaking back out, right? Showing strength here. Viking Therapeutics gives you an opportunity to own it above $65 with a price target somewhere around $95. Doesn't seem like that big of a move because it's a log chart to show the entire base that we're playing the breakout of, but that constitutes like a 30 to 45% move. So it's worth your interest if you're trading shares. From an option standpoint, this trade sucks. So once again, only trade shares. Clear Secure, $4 billion software stock that we're already in. We owned the 24 area breakout. We're looking at this consolidation fractal underneath the $29 pivot. We want to own the October 30 calls. I know you're like, Hamilton, what the hell? You're buying in October? Yeah, we're buying October. Go look at the chain on these things. Somebody is buying the shit out of these. We're going to own this for the next 2 months. That's it. 4.72 ADR. I have no want to own this out to January with that high of an ADR. If this continues to work for us, the first trade worked for us. If the second trade works for us, maybe we'll be convinced to go own the Januaries. But right now, we want to own this thing above the 28.5 pivot, $30 calls, no more than $1. I think they're going for $1.05 right now, so make sure you don't get screwed on the fill. Good opportunity here to own a reservation of a high and tight price target, $36. $30 calls puts you $6 in the money. You have 2 months to get there. Lifetime Group, I think this is one of the last trades here. Just showing you that we bought this range high breakout. This is our bread and butter setup. It's a shares related trade. Don't go out and own options on this. They suck, but this is a massive 5.49 ADR. If this pulls back into the 22-25 area, you can own it with shares. This is a big mover. Expecting big things here. It's a consumer discretionary name, right? They own gyms. 50 RSI up and over it. 200-day moving average sloped up. This looks like a really good play. It's just taking a little bit longer to get moving. Okay, that was the end of the trade ideas really quick. We're going to wrap this up with gold and the dollar. Gold looks fantastic. High fives all around, TTI. Hell yeah. We've bought bonds this year and they worked. We bought gold this year and it worked. Who would have expected that? The gold trade that we originally opened off the 191 up massively, and then the add at the 215 area is up. Not massively, but it's up about 50 to 70% depending on where you got filled. We're not looking to add into this trade right now, but we are looking to take half off at 100%. So if you're in those December call debit spreads that we opened up at the 215, be very diligent to close half at 100% so you let the other half continue to run up towards that 250 price target. We're about halfway there right now, so congratulations. Has not been the quickest trade, but it's worked for us. Talking about quickest trades, EGO 7-year high, another trade that we have on the books. We have about a month left to hold these things. Not a great trade. Don't let anybody tell you this is the problem with Twitter, etc. If I just posted this chart and I said we owned EGO off of 1375 pivot, it's currently trading 17.5, you'd say, wow, it's an incredible trade. You're up 30%. What they don't know is we bought options contracts. Even with 6 months worth of expiration, this trade is up 30% from the underlying, and the options trade itself has chopped around and is minored down right now. Now, we're very close to in the money. I have high expectations that we're going to be able to get out of this at break even or a small profit. It's not going to be 1,000% winner by any means, but it goes to show you that charting and options trading don't go one-to-one. So for those of you, we had this conversation inside of the Discord today that are struggling with options trading particularly, you need to figure out where in the process it's going wrong if you're consistently buying the wrong options contracts. This, we gave it plenty of time. We chose a realistic price target. The Greeks were all with us, and the options trade itself didn't work as well as the shares trade. So food for thought there between people that don't like trading shares. There's a lot of opportunity. I'm adding silver here just because it's always brought up. This is not a trade that we're going to want to take right now. Very minimum has to be up and over 27 bucks. It sucks that gold's breaking out and silver is not showing the same sort of strength. We don't get to choose what the market does. We only get to choose how we react to it. Significant overhead supply until we're up and over the 27 pivot. Last thing I want to talk about really quick is the dollar. Arguably the most important chart of this entire presentation. So, of course, I left it until the end. Guys, the last couple of years, the dollar has been inversely correlated to the market, meaning when the dollar dies, the market tends to do well. When the dollar rallies, the market tends to face a headwind at best or capitulate at worst. Right now, we're bouncing, at least it looks like in the short term, bouncing off of a multi-year support level. Now, I don't want to scare you. I don't want to tell you the world is ending. I don't want to tell you to close everything. But what I am telling you is every time the dollar's been down here over the last 2 years, the market stops accelerating upwards at the pace that most people want it to, meaning we're not gapping up and running 3% per day on most stocks when the dollar is going up. Now, the dollar doesn't have to go up and stocks have to get crushed. The dollar can meander upwards and stocks can go sideways or stocks can slowly creep up. But I'm going to tell you right now that seasonality telling us that September is the worst month in the market for up days. That doesn't mean we're going to capitulate into new bear market lows. Has a 47% up day ratio, right? So on average, 47% of the days we trade in September should be up days, meaning a majority of them are going to be down days, okay? Have that expectation now. The dollar, coincidentally, finding potential support at the same area it's found potential support over the last few years. This does increase the odds that the market is not going to go parabolic, that maybe outside of a spectacular NVIDIA earnings, we shouldn't expect the Qs to be at all-time highs tomorrow. Or what is NVIDIA report? Thursday, I believe, next Thursday. Just keep expectations in line, all right? If the dollar starts to bounce and the market starts to shudder a little bit or go sideways, it's not the end of the world, all right? I'm just trying to build that expectation. Now, as a matter of fact, if we look at the dollar against the S&P 500, you can see there is an inverse correlation up until earlier this year for a slight amount of time over the last 2 years. Dollar goes up, market tends to go down, and vice versa. As of right now, the dollar finding potential support. What happens to the market when the dollar starts to find support? I'm not a soothsayer. I can't tell you with 100%, but if this inverse correlation holds, which so far it does look like it is, we might be able, or we might have to hold through some uncomfortable, choppy water over the next few weeks. All right? Expectation sets. What are the big themes? First off, I didn't mention this, but we have the Jackson Hole presentation tomorrow, right? That's particularly going to be a big thing. Into September, we have our potential first rate cuts. It's coming up relatively quickly, guys. Choppy summer is normal. Protect the downside, but continue to take setups. This is not the time to just sit in cash. There are still breakouts happening. We still have 5 or 6 sectors at all-time highs. We have the equal weight S&P 500 at all-time highs, but you want to protect your downside. If you need to hedge to get through the night, to sleep better, feel free. We talked about that inside of the Discord the entire power hour session, how you could hedge against the Qs, the S&P 500, small caps. If you need to hedge to feel better, totally fine. If you need to reduce exposure to feel fine, that's okay too. Protect that, but don't sit idly, because a lot of these breakouts that are occurring right now, as the markets, or not the markets, but the equal weighted index and the sectors are breaking out to all-time highs, those potentially could be market leaders through the end of Q4, which is the next talking point. Stocks showing leadership through the summer of last year led Q24 2023. The stocks that showed leadership in the summer last year ended up running the hardest by the end of the year. That's what we're trying to buy right now. I'm not going to tell you it's going to be comfortable. I'm not going to tell you you're going to win all of them. But there's not a lot of downside potential. It looks more like we're going to be range-bound chop. All 3 indexes are back above pivot points, so green lit to buy anything in the market that is showing absolute strength. Feel free. See, September seasonally weakest month with 47% up days. We just talked about that. Just build that into your expectation. You're going to be able to sleep better at night. Points of emphasis. Rotation should not be misconstrued, as a rollover. I tried really hard throughout this webinar to prove to you that a pullback in the market is not necessarily indicative of a rollover. We've seen so many stocks right now breaking out and sectors breaking out to all-time highs that the big boys at the top pulling back does not necessarily mean the entire market. From a market breadth standpoint, every single stock is going to pull back, okay? It's very important to understand the difference between rotation and rollover. Right now, it looks more like a rotation, which means we have aggressive opportunities in other areas of the market. Closing half and 100% allows risk-free end-of-year plays. We talked about this inside of the Discord a lot this week. We just turned NVIDIA free. I want to point that out. We have December 150 calls in NVIDIA that are free going through earnings. Part of the perk about being inside of the Discord is we can talk through these types of plays and take a little bit riskier entries. And now we have an opportunity for a potential lotto ticket in NVIDIA with no capital in our account risked, right? If it doesn't break up, if it doesn't break out into all-time highs, if earnings tanks NVIDIA, by the way, the market's probably going to tank if NVIDIA tanks, we're not going to lose any money off that NVIDIA play. If it moons, we're going to make a bunch of money, right? So literally risk-free. Close half of your trades if they cross 100%. This is not the time to get greedy. This is the time to stack lotto tickets for the end of the year, because if we get the push that statistically we should, a lot of those lotto tickets are going to end up as winning trades, and some of them are going to end up probably as huge winning trades. Lastly, do not get complacent. The biggest wins come after a correction. It's the same thing I said 2 weeks ago. Do not get complacent. Happened last year. People got bored that the market was doing nothing for 3 months, and they left, and they came back in the middle of November to a market that was running away, and then they had to play catch up. Do not get complacent. I don't have to sit at your computer 24 hours a day monitoring everything. I do that. You don't have to do that, but don't leave for 4 weeks expecting chop and then come back and be like, oh shit, because the market can pivot quicker than you can catch up, right? My name is Hamilton. I'm here at the Trading Initiative. If you have any questions regarding anything that we just went through, feel free to leave them below on the market research side. I will post the video right now, and those trade ideas will be out tomorrow morning before market open. One more time, Jackson Hole tomorrow. Jay Powell is speaking. See how this thing plays out, all right? Enjoy the rest of your Thursday night, and I'll talk to you guys in the morning.